Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Chief Economist Don Rissmiller. Don, how are you doing today?
Very good, Ross. Good to talk with you.
Great to talk to you as well. I want to start with something that just occurred that has gotten maybe more headlines than it normally would, which is the the annual revision to the main headline payrolls number that we watch so closely every month. It was a big downward revision. And I wonder if, one, you could kind of put that in context for us. And then two, just discuss if it changes the outlook for the Fed in a material way or if it's kind of in line with what we've already been seeing.
So it's a great question, and it's a notable data point, but I wouldn't say it's an A-list data point. This isn't like we're getting a new payroll employment report that's up to date. We're getting information on what happened last year and the first quarter of this year. So naturally, it's old news the way these revisions are constructed, and this isn't even the final revision. This is the preliminary revision, so we're not sure that this is actually going to be what the number looks like. Still, it was a notable downward revision. Now, this is the payroll survey. So if there have been issues with immigration over the past several years where immigration has increased, it is possible the payroll survey altogether, revised or unrevised, is missing part of the picture. And I do think that's some of what's been happening here. Also, we have to think about how the central bank would respond. And I think they're looking for up-to-date data. So they're going to watch weekly jobless claims. They're going to watch the employment release that's up to date. They're going to watch the unemployment rate. And there have been cracks there, but they're small cracks, not big cracks. And I think this number that we got fits with that story. There are some cracks, but I don't think we can take this and jump to the conclusion that there has to be an emergency move or an emergency rate cut or a large rate cut. Maybe the data as a whole will get us there, but in general, reacting to any one data point is a bad idea, and I think that fits this story as well.
Yeah, I think that's great context for, again, something that made more headlines than it might have otherwise given the context. Speaking of the Fed, and we're obviously heading towards some rate cuts here. How much, the magnitude, the speed will be determined by the data. But I'm curious on a bigger picture scale, how do you think about, or how does the Fed think about kind of the neutral rate, like where they would like to get to if the economy holds in kind of a steady state? Do they have a target for that? Is it moving based on the data? If the Fed had its way, where would they land, say, at the end of 2025 if things kind of held firm over the next year and a half?
It's an important question where we're heading in the long run, and the Fed does try to answer that. They do have a dot plot with a long run estimate. They also have a number of models. The Fed is a model-based organization, so there are a number of models of what the policy rate should be to be neutral in the long run. What we see out of that exercise is that the neutral rate that comes out of a model has not moved much, somewhat surprisingly. So there's been a lot of conversation that the neutral rate must be higher because the economy is doing well with a higher interest rate. And that's almost irrefutable. So what I think we have to do is separate a short-term neutral from a long-term neutral. And what we're really talking about in this conversation is the long-run neutral. And there's evidence that that has not moved a lot over the past decade. So if the long-run neutral real rate is 1% or a little less than 1% in real terms, because these models are going to be run inflation adjusted in real terms, then take your inflation rate, add 1%. That's probably giving you an estimate of where the Fed wants to get to over the long run. That may not be the end of 2025. We may be moving in that direction over the course of 2025, but you may not be there if everything goes well until 2026 or longer. But a simple answer would be take the inflation rate, add 1%, think about that as your long-run nominal neutral rate, and move there at a relatively slow pace because there's not a ton of confidence there's a large standard error band around these estimates.
That's great context. Final question. I'm curious, this is something we've talked about in the past, but productivity. What is the latest productivity data saying? Are we seeing an uptick based on all the discussion around AI and new technologies? Has it plateaued post-COVID? What are we seeing on the productivity front, and why is that an important data set to keep an eye on?
So there have been some encouraging data points recently, but I think we have to be careful for the same reasons we've been talking about. If we're not getting the immigration data correct, it's possible we're not getting the hours data correct, which would mean the output per hour data, the productivity data has to be interpreted in a very nuanced fashion right now. But the data itself is showing some early signs of encouragement. This probably isn't the full AI story. It's just not a long enough period of time for AI to take hold. I think that's the story over the next decade, and I think there is still reason for hope on that front. So productivity has moved a bit higher. Maybe some of that is noise versus signal, but there's a real story with artificial intelligence and its knock-on effects that I think can impact the economy for quite some time here.
Well, we'll be sure to talk to you again in the future to get updates on that. But Don, I want to thank you so much for the time today. This has been a really insightful conversation. And again, hope to talk again soon.
Take care, Ross. Thank you.